Welcome to The Close. I'm Lindsay Biscaya in for Morella. Today, markets are closing in half an hour from now. So first, let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. U.S. President Donald Trump is threatening Iranian energy sites if the Strait of Hormuz is not reopened soon. In a post on social media, Donald Trump said the U.S. would respond by blowing up and obliterating Iran's power plants, oil wells, and Karg Island. The remarks come after a brief pause in attacks on energy infrastructure as the two countries held talks aimed at easing tensions. And we are watching shares of Air Canada today after news that Chief Executive Michael Russo will retire by the end of September. Now, the move follows backlash after he released a condolence video for victims of the LaGuardia airport crash in which he did not speak French. The airline says the search for a new CEO is underway, and the ability to communicate in French will be considered in that decision. The federal government, along with the government of Ontario, will spend $8.8 billion over 10 years to lower Ontario's development charges by up to half. The funding is aimed at reviving the home building market and will allow municipalities to cut up to $200,000 in taxes and fees for a new home. Developers have long cited the increase in development charges as the biggest hurdle in getting more homes built. And we're watching the TSX today falling after seeing some significant gains last week, currently down by 0.5%. U.S. markets, a similar story, flip-flopping today, but currently all three of the big ones, S&P 500, Dow Jones, and NASDAQ, are trading down at the moment. The NASDAQ down by more than a full percentage point. And of course, this is all fueled by developments in the Middle East. A lot of investors trying to figure out exactly what's happening there. And obviously, we're watching the price of oil, WTI, rising again, up by more than 4% at the moment. So we're obviously continuing to track that today. And as you just saw, stocks are heading lower as the markets continue to watch those oil prices and the Iran war. So for more on investing in this environment, joining us now is John Bay, Chief Investment Officer at NEI Investments. It's great to have you join us. Thanks so much.
Thank you for having me.
So we've been watching this for over a month now, ever since that conflict really broke out in Iran. The markets have been flip-flopping. What stood out to you in terms of how various assets and sectors have kind of been reacting over the last 4 weeks?
Yeah, it's been really interesting. I mean, the stock markets initially held their value very, very well. When you have oil prices spiking to over $100 per barrel, the natural, historically, have been the knee-jerk reaction is for the equities to sell off. But the U.S. markets for many weeks held near 5% near the all-time highs, and which led many investors to think, is this resilience or is this complacency? But what's really been interesting in terms of, from an investor perspective, is that over this time period since the war started, even though oil prices have spiked to over $100 a barrel on the WTI front, earnings estimates in the U.S., Canada, and Europe have actually gone up over the last month, which has given investors, again, some hope that the war is temporary effects we can look through. But if you look at the underlying fundamentals of the earnings power of companies, they're actually pretty resilient right now. We don't know what we'll see that a little bit more details on that as we head into the first quarter earnings season in a couple of weeks. But right now, it's pretty interesting that earnings estimates are going up, not down, despite the war that's going on.
It's really confusing to watch all these different factors, as you mentioned, play out. Like, what exactly are equities and oil prices reacting to then? As you say, earnings are strong, but it seems as though the markets in general still trending down most days.
Yeah, the having the war and the effects of war, the longer this lasts, the more downward pressure you're going to see on the equity markets. As we started to, have the supply constraints of oil, and over this weekend we saw the Houthis begin to attack and expand the war into the Red Sea. And what we're looking for is not only the duration of the war, but also the intensity of the war and the effects on whether or not it will hit the infrastructure and how much of that damage will be long-lasting. Last Monday, the International Energy Agency came out and said that 40 energy infrastructures have been hit and with severe or very severe damage. And the longer that it takes to resume oil production to quote-unquote normal levels, that the upward price on oil and gas and natural gas prices, creates a tax for the U.S. consumer at a period when they're having to deal with other rising costs. So it'll be, that's why we're watching the duration and the intensity of the war very closely and the effects on infrastructure.
Yeah, no kidding. But it is a time for investors can maybe grab a hold and see some opportunity amongst all this kind of volatility. Is there any energy companies that you would consider investing in at this moment?
Well, it's really interesting, right? Because Canada, is relatively well positioned versus the United States and Europe in terms of our exposure to hard assets such as energy, the energy sector, as you talked about. If you take a look at the current rise in energy prices and look at the futures deck and put that against the cash flows of the Canadian companies, you'll see that valuations are actually still fairly reasonable when you look at an EV to EBITDA. So, from a macro perspective, I can't talk about individual names, but we can say that at current prices, the Canadian companies are certainly well positioned in this time of uncertainty during the war.
You also say you favor moving to defensive sectors. Which ones, and why do you like defensive sectors right now?
It's interesting, in terms of, in terms of what we saw over the last 3 years. We saw a move to AI, the hyperscalers, and a generational growth in AI CapEx spending. But we're starting to see that the markets rotate out of the intangible software type names into the hard asset names like gold and energy and mining companies. And again, we think that the effects of war have highlighted, we are seeing a renewed interest in hard assets, and we think that focus on hard assets will continue. And again, that positions Canada relatively well versus some of the other stock markets around the world.
You also say you like commodities at the moment, or you say investors should be focusing on certain commodities like gold, silver, and oil. We've talked about oil, but what are your thoughts on what we're seeing with gold and silver? It's been a bit of a roller coaster as well.
Yeah, on the gold price, interestingly enough, we've seen gold prices pull back since the start of the war, which many of us thought that that would be a catalyst for gold prices to go up. But when you look at what gold, the two main drivers of gold historically are real interest rates and the U.S. dollar. And real interest rates and the U.S. dollar both have increased during since the start of the war, and that's put downward pressure on gold. Having said all that, as the geopolitical concerns around the war start to dissipate, when that is will depend on the news flow over the next couple of days and weeks. But again, we've seen a U.S. dollar that has been under pressure over the last 12 to 18 months. We expect that to continue once the geopolitical news of the war, and that will help gold on a go-forward basis.
Okay, so much to watch for. We'll leave it at that. That was John Bay, Chief Investment Officer at NEI Investments. Appreciate your time. Thanks for joining us. Coming up, Air Canada's CEO will retire in the fall after a slew of recent controversies. We've got more on that decision after the break. Stay with us. Air Canada CEO Michael Rousseau will retire in the fall after nearly 2 decades with the airline. This comes after the aftermath of the fatal Air Canada plane crash that claimed the lives of 2 pilots. Joining us now to discuss this latest decision is Ian Lee, a professor at Carleton University's Sprott School of Business. Professor, good to have you join us. Thanks so much.
My pleasure, Lindsay. Thank you.
You say the decision to force the Air Canada CEO into early retirement is a terrible precedent for Canada. Why do you think that?
It is. And full disclosure, I've been flying on Air Canada for probably 40 odd years. I do not consult to this industry, nor do I have any investments in this industry. And my former wife is a Francophone, and my two children and my two grandchildren are 1,000,000% bilingual. I am not opposed to bilingualism whatsoever. This is a terrible, terrible decision for Canada. It sends a message to the world, and in this world of increasing globalization, which is still continuing, the stats from WTO are clear, constant growth of international business in an industry that is one of the most globalized industries of all, called aviation, where the ICAO, that's the UN body that sets the rules for this industry, clearly states that English is the language of international aviation. We are sending a message saying the only people that qualify are bilingual people, which reduces the pool for eligible executives to a small handful of people in Montreal. And even if you expand it to the world, the Francophonie says there's 400 million people in the world out of 8 billion human beings. That's 5% of world population that speaks French. And we're saying everyone else is unqualified. Surely that's an extravagant and extraordinary comment or suggestion or policy that is not adopted in any other industry that I've studied in my 35, 40 years studying corporate and business strategy.
It's interesting to listen to how all this kind of unfolded, right? Like, it sounds as though the main issue, obviously, here with the crash itself, and I know you're not here to speak on this side of it, but was with the air traffic controllers and potentially a staffing shortage. That's a whole other issue. And then this side of it seems to have been overblown. Like, do you feel that the issue of not being able to speak French properly in that condolence message was actually overblown, or do you think it's valid that people were upset with that?
I think it's completely overblown. It was a tragedy. As someone who flies, and I've flown into that airport, I've flown into an awful lot of airports around the world, including Europe. I'm in 2 days from now, I'll be in China, flying into Shanghai to teach. And that's something that's always, I've flown into LaGuardia. Terrifies me because I know how busy it is and how dense it is. And it was an absolute tragedy, these two young men with their whole careers ahead of them. And so for people to manipulate this tragedy and turn it away from the horror for their families and their parents. I am a parent. I mean, I can't imagine losing my son. And to then turn it away from the tragedy of the death of these two and turn it into talking points and social media gang up because people had some kind of a political agenda, I thought was appalling. I thought it was really unethical for people to do that who have any sense of compassion.
And as you say, now Air Canada, the company, looking for a new CEO. If they're bilingual, then that, as you say, reduces the pool for eligible executives. Air Canada not exactly immune to bad PR, but what do you think this means for the company moving forward? Like, what will the company look like moving forward with a new CEO who's maybe not as qualified as they should be, but speaks both French and English?
Right. I'm going to be go out on a limb. I mean, I've been teaching corporate strategy, studying it. I'm a former banker. I was 9 years in banking, lending money to companies that were going in the right direction. That is to say, creating value for their customers, which is why firms exist. It's not to make money. It's to service your customers. And so I hope that Air Canada, I don't want to, sugarcoat Air Canada. Air Canada has made some terrible mistakes. They should never have agreed to pushing him into retirement. They should never have agreed to change the terms of reference for the search for a CEO, which is to find the most qualified person in the world. So they should stand up and say, we apologize for the mistakes we've made, and we are now going to repudiate this. We are going to find the most qualified person anywhere to run an airline. And for those who don't like what I'm saying, who say it's essential you speak French, I challenge everybody to go and look at all of the publicly traded airlines in the world: Lufthansa, United Airlines, Chinese Eastern, which I fly on, many airlines. I would suggest to anyone who studies this that most CEOs of most international airlines don't speak French. English is the international language. And so they should speak truth to power, confront these people who are demanding that the corporate strategies to find the most qualified person in the world be set aside for social engineering motivations. They should say, this is not the way to go. This is not the way to run a major corporation that's running, flying planes around the world, taking my life and all the other people that fly on those planes. They're responsible for us. And now they're going to go out and recruit somebody from a tiny, tiny, tiny pool instead of going for the most qualified person in the world. They should say, that is what we are going to do, and challenge the government. If the government really wants to, I hope that the government of Canada is not so irresponsible. If they want to table a bill in Parliament to mandate that Air Canada must only recruit people, well, then let Air Canada, let the Parliament of Canada go down that road, and then let people like me come out and write op-eds and attack the government of Canada for acting so irresponsibly with the lives of the millions of people that fly on Air Canada. We want the best people, the best person in the world that they can possibly recruit, not somebody who's fulfilling some social engineering political agenda.
Okay, we'll have to leave it there. Ian Lee, professor at Carleton University's Sprott School of Business. Appreciate you joining us today. Thank you.
My pleasure. Thank you.
Coming up, U.S. oil settled above $100 a barrel for the first time since the war in the Middle East began, which has entered its fifth week with little expectation of a near-term off-ramp. We're back in a moment with more on that. Stay with us. Despite recent statements about progress toward peace, U.S. President Donald Trump has warned that the U.S. would destroy Iran's electric generating plants, oil wells, and Kharg Island if the Strait of Hormuz is not opened. Our next guest says that negotiations appear stalled as both sides are unlikely to accept maximalist demands. So let's welcome in Daniel Shapiro, Distinguished Fellow with the Atlantic Council's Scowcroft Middle East Security Initiative. It's great to have you join us. Thanks so much.
Thanks. Good to be with you, Lindsay.
Given the history between these two sides just over the last 4 weeks or so, do you really believe that President Trump expects Iran will accept these demands if they're threatened with more strikes?
I don't really know what President Trump believes. He rather inconsistently describes what he's trying to achieve. Sometimes it's regime change. Sometimes it's limited to precise military objectives. Now, of course, he has the Strait of Hormuz to worry about, or what tools he's willing to use. He initially had said, of course, he doesn't want to bring ground troops into the region, but now we have several elements, 2 Marine Expeditionary Units and members of the 82nd Airborne Division of the Army present, and some others coming, which give him options to do ground operations. So exactly what his goals are and exactly what his methods are is unclear. Meanwhile, he tries to paint a very sunny picture of negotiations that he says are ongoing. I think if they exist at all, they're indirect. There can't be much in the way of direct contact, perhaps some texting between the foreign minister of Iran and Steve Witkoff. But as you said, the gap between the two sides' positions there is very, very large. And so if it's going to happen that there is some sort of deal that's a de-escalatory off-ramp to this conflict and a reopening of the Strait of Hormuz, which is really an essential new component for the United States, it's going to take time. And of course, he's looking for tools of leverage. Those included threatening to bomb electrical plants and desalination plants, hardly a way to win over even his Gulf partners, who will worry about Iran retaliating against the same facilities in their territory.
Mm-hmm. It doesn't really seem, though, like the regime has been taking these threats by the U.S. Very seriously. So if Iran decides not to open the strait by the deadline of April 6th, what do you think happens next?
I think it's very likely we will see U.S. ground troops engaged. I think there are a few options for that. He mentioned Kharg Island. Today he said destroy it. Previously, there had been discussion of the United States seizing it to have control of Iran's oil exports. Another option is to seize various other islands in the strait or shoreline along the strait to try to make it safe for ships to transit. And a third option that's been mentioned is a special forces operation that would extract highly enriched uranium that Iran still has even after the bombings of last June. So I think it's increasingly likely we will see that. Again, it's not exactly clear that that's something President Trump wants to do. He's sort of trying to maybe threaten Iran to make concessions and trying to talk down oil markets from increasing the costs of oil and gas and fertilizer and other commodities that are stuck because they can't travel through the strait. But if his deadline comes, he, of course, has already extended that deadline more than once, but sooner than later, with those forces in the region, there's an imperative to try to use them, or else you really have to send them home. You can't just hold them in the Middle East forever.
When it comes to the deployment of U.S. troops into the Middle East, you have identified potential missions, including securing the Strait of Hormuz, seizing Karg Island, or obtaining Iran's highly enriched uranium. In your view, which of these missions carries the most risk?
They all carry risk. Probably the nuclear material extraction is the riskiest. That's farther inland. There may be more than one site where highly enriched uranium is located. It would require bringing in a significant special forces component as well as significant air cover and perimeter security and bringing in excavation tools and people who know how to handle this radioactive material, and really to hold that territory for days or a week or so. It's not something that can just be done in a few hours. And indeed, it may be in more than one location. So if the idea is that the extraction of the HEU, the highly enriched uranium, would solve the nuclear problem, or at least, potentially by a significant amount of time before Iran could reconstitute, and you took out, let's say, half of it, because that was what was at Isfahan, but the other half is still buried in the underground enrichment facility at Fordo that was bombed in June or has been moved somewhere else, you really haven't solved the problem. Iran still would have the capability, if it could set up an enrichment location, to sprint to a nuclear weapon. So it's risky. It may not fully solve the problem, but that one, I think, is of all of these options the riskiest. But there's risk with all of them, for sure. And among the risks is that the war simply extends for many more weeks or even into months. And while that happens, the strait remains closed. Iran retaliates against for other Gulf energy and gas and oil targets. And the economic crisis we're facing globally really metastasizes.
You'll have to be really quick with this last answer. We've got about 45 seconds left. Do you foresee a situation, though, where the U.S. might be compelled to withdraw from this conflict?
I foresee a possibility that President Trump will try to find a quick off-ramp that doesn't involve and ground forces going in. Quick meaning 2 to 4 weeks of gradual de-escalation, some diplomacy, some pressure from other countries on Iran to open the strait as the shooting stops, and see if he can claim victory that way. That's the quickest way I could see it ending.
Okay, we'll leave it there. Appreciate you joining us and giving us your insight. Thanks so much.
Thank you.
That was Daniel Shapiro, Distinguished Fellow with the Atlantic Council's Scowcroft Middle East Security Initiative. Up next, we've got the closing bells on Bay Street and Wall Street. Stay with us. Here are the closing bells. At the Nasdaq, BlackRock is ringing the closing bell. At the New York Stock Exchange, Koppers Holdings rings the closing bell. You are watching the close on BNN Bloomberg. I'm Lindsay Biscaya. Here's how we close the day on Bay and Wall Street. TSX finished the day down after seeing some significant gains over the past week last week, but this seems to be the stories to start off this week. TSX down, S&P 500 down, the Nasdaq also down as investors trying to figure out exactly what is happening in the Middle East, how long this war might go on for, and what that is doing to oil prices. So we're also watching a couple of specific companies on the TSX. Air Canada, watching that stock price today after the CEO announced he is retiring amid some backlash over that almost entirely English-speaking message in the aftermath of the plane crash last week at LaGuardia Airport. Air Canada finishing the day down by more than 2%. We're also watching Waste Connections. It's up the most in 11 months as the TSX was kind of gaining around midday today, but obviously finished the day down. Waste Connections finishing the day up, though, by more than 4%. And America's Gold and Silver Corporation down, one of the biggest laggers on the TSX, really, despite announcing some strong full year 2025 results and 2026 guidance, down more than 15% to end the day. As you just saw, markets were heading lower. Oil prices continue to climb as the Iran war enters its 5th week. As investors watch the impact of the war as well as AI on stocks, joining me with some investment ideas is Jed Ellerbrook, portfolio manager at Argent Capital Management. It's great to have you join us. Thanks so much.
Hey, thanks for having me today, Lindsay.
Another interesting day on the stock market. We saw some seesaws over the past month and once again today. How do you see investor sentiment shaping up when there's just not a lot of clarity at this moment?
Yeah, that's absolutely right. Investors are trying really hard to discern what's going on in the Middle East and what impact that'll have on oil markets and fixed income markets and also equity markets. But then, of course, the unprecedented nature of AI and its really fast rollout into our business work lives as well as our personal lives is unprecedented and hard to gauge and price on a company by company basis as well. So we're seeing lots of gyrations this year so far. We're seeing value stocks outperform more growth oriented companies significantly, which of course is a pretty big reversal of what's been going on for the last decade.
Just so many factors to watch, including inflation. U.S. Fed Chair Jerome Powell coming out today saying that inflation expectations were well anchored and the Fed would not feel pressured to hike rates due to the rise in oil prices. What do you make of what Powell had to say today, and what would this mean for the rate roadmap in 2026, do you think?
Yeah, I think his wait and see approach is prudent, given all the unknowns we just discussed. So, we will see how long oil prices stay high and what flow-through impact that has on broader inflation. And that will guide the Fed's decision-making going forward as to how much they can cut rates, if at all, this year. I think the bond markets today expect, a month ago, 2 months ago, we expected, 2, perhaps 3 interest rate cuts in 2026 in the United States. Now the market expectation is closer to no change or perhaps even a small increase prior to him speaking today. His comments today were pretty constructive, I thought, for rates still moving down a hair over the course of this year, and you see rates in the bond market declining in response to his comments at Harvard today.
There's a lot to go over here. Also, you talked about earnings off the top there. And as you say, strong earnings usually drive the markets up, and particularly for each stock. We haven't really been seeing that recently with a lot of companies, including the big 7. Why do you think that is?
Yeah, there has a pretty big gap has opened up, especially in tech, between earnings growth, which remains double digits in the high teens or perhaps north of 20% for tech companies. Meanwhile, their stocks are underperforming the broader markets and, in fact, going down in many cases. So that has compressed PE multiples really across technology. We're seeing now Microsoft trading under 20 times next 12 months earnings. The same is true for NVIDIA. Amazon isn't terribly far from that range. And so, this is the first time I think in my career where a company like ExxonMobil or Chevron, energy companies that typically trade at lower valuations, Exxon and Chevron today trade at a higher multiple than NVIDIA and Microsoft on next 12 months earnings. That's unprecedented and creates, I think, a really interesting entry point for investors into some of these tech companies that investors are really concerned about them overspending on data center capex. And then on the other side, also concerned about other tech companies and the threat that their businesses might be disrupted, their growth might be stopped by these new AI tools that are, quickly being released by companies such as Anthropic and OpenAI.
Okay, so that's a good segue into some of your stock picks for today. The first one being Amazon. I know you were just talking about this company along with some of the other hyperscalers. Is this a stock that you think is driven by AI?
Yes, absolutely. I think Amazon's business is performing really well. I think the retail business is it's growing double digits, margins expanding. This big increase in oil prices is a bit of a problem for Amazon. Amazon and their delivery drivers consume a lot of gasoline. But nonetheless, I think that double-digit revenue growth and expanding margin story in retail continues and is appealing for investors. And then the other side of their business, AWS, revenue growth is accelerating. I think it's going to exceed 30% growth year over year here in the next couple quarters. And I think that's a really big positive for the company. And their future growth outlook looking into 27 and 28 is really strong as well. So like that business, think the valuation is attractive. I think about 24 or 25 times next 12 months earnings. Think that the management team is doing well. Like that stock a lot.
Amphenol is another one that you like. Why do you like that one?
Tell me the name of that stock again. I'm sorry, I didn't hear you.
I might have said it wrong, to be honest with you. Amphenol?
Oh, Amphenol.
Amphenol.
Yeah. Yes, I apologize. Amphenol is a supplier to NVIDIA and other semiconductor companies. Their products are used in data centers as well as in automobiles and other industrial uses. Amphenol is a long-time kind of high-quality compounder business that's grown at a high single-digit pace. They've also been good at mergers and acquisitions, bringing in new companies that can contribute to the company's growth. And a strong management team. So I expect that company will continue to do well. The stock has been weak lately because a lot of their products have copper interconnection content, and investors are worried that optical products replace some of those copper interconnect products on future NVIDIA semiconductor systems. So I think that's presented an interesting opportunity for long-term shareholders to buy Amphenol.
And just lastly, your healthcare name that you really like is Danaher. Why do you like this one?
Yeah, that's right. Danaher is an outstanding business that's gone through a couple tough years in a row. There was a boom time, the couple years immediately after COVID hit in 2020 and 2021, followed by a pretty rough period where customers overbought products and tools and needed to kind of consume those inventories. This year, Danaher's growth is resuming. I think they can get back to mid-single-digit organic revenue growth. And they've also completed an acquisition of a company called Masimo that I think is kind of a typical Danaher acquisition. The company has a good track record integrating those deals, and I think it was reasonably priced. So we like Danaher shares today. They're about the cheapest they've been in the last decade or so.
Okay, we'll have to leave it there, but I appreciate your time. Thanks so much for joining us.
Have a good night.
You too. That's Jed Ellerbrook, portfolio manager at Argent Capital Management. Coming up next, the energy supply shock shaking global markets has some North American companies positioned to benefit. We'll break that down right after this. Strikes at Qatar's LNG hub are rattling energy markets, causing the U.S. natural gas producers to spike. To help break down what that means for prices and supply, we were joined by Thomas George, president and portfolio manager at Grizzle Investment Management.
I think this is structural, and this is a functional change, and something we have been structurally very bullish on the energy complex as it relates to disruption, specifically all of the technological disruption in the economy. We've been very unique in that stance. We've seen that the value of these commodities have really come through. But I think what this current situation in Iran has really highlighted is that diversification, security of supply continues to be such an important component of the global energy mix. And I think that North America specifically is going to be viewed in a very different light as a core backbone to the energy infrastructure in a world that is energy starved, really, as it relates to the AI revolution.
What will be a real turning point for you in that to make you say, yeah, this for sure is going through?
Yeah, so I think all of what has happened in the last month is the turning point, right? So if you are a buyer of energy, specifically LNG, you are looking at a moment where basically you've had your supply cut off. And now if you're going to look out 5 years, 10 years, are you really going to go back to and I'm talking emerging markets, Europe, are you really going to go back to that same distribution mix coming from Qatar, maybe predominantly, maybe 50%, or are you going to now distribute that across North America, Australia? I think that component is just going to be a very different view. And I think the assets around that, the LNG assets around that, we still think do not get the valuation bump that they deserve when you're looking out long term.
Can they handle it? And if they can, is there enough time to kind of get up to speed?
Yeah, so I think in the current, all that's happening currently, obviously, we're in a pinch point right now. If we see through to a normalization, which that could take a year, we think that as everything realigns over the next 3 to 5 years, that is when you start to see the growth the pointing to the growth in the North American complex. And I think that definitively we can definitely backstop into that. Are there going to be pinch points? Of course, but I think that any price signals just underscores the value of getting more volume out of North America.
And what kind of a role do AI data centers, the build out with LNG?
Yeah, so I think AI data centers are obviously an important component of the demand growth mix. Clearly, that this has sent a shock into the system in terms of how almost the timing couldn't have been more challenging for the global economy in terms of just the demand wedge that AI is driving. Now, of course, AI is going to look for a diversified feedstock with respect to energy, but LNG, without a doubt, is going to be an important component. And so I think AI is going to continue to think about, and if you think about all of AI's incremental energy demand out of North America particularly, that's all come through gas, right? That has been the fastest way to deploy energy. Now, we think the next step is obviously going to be nuclear, but again, all of this still will be functionally feeding the AI growth cycle.
Okay, and you've got some stocks. I want to get to them. Comstock Resources.
Yeah, so Comstock Resources. So our view is that you play this through the entire value chain. So we think you own the LNG exporters. So for us, that's Venture Global, Cheniere. The Venture Global's our largest holding there. So I think that's a straightforward play that you'll get a real tailwind there. And then you own the basin plays as well. So Comstock for us, it makes a ton of sense. Low cost, dollar. Their costs are $1 per MMBTU. Market's at $3. You functionally have to believe in the long-term view that $3 is going to converge. It may not converge completely, but it's got to be higher than where Asian and European prices are currently for natural gas. So it really is a margin expansion play there. And in Asia and Europe are trading at $20 per MMBTU in or around. So, I think that for us just makes a ton of sense. And for us, Comstock fits well there. Okay,
Antero Resources.
Yeah, so Antero, again, very similar. For us, Comstock feeds right into the, their basins feed right into the LNG terminals. But for us, Antero, Marcellus and Range Resources fits in that as well. Now, their prices are higher, their costs are higher at $2. But again, for us, these are high quality names. Now they have more liquid, so they do gain with the oil price as well. But again, for us, it's a combination where if Comstock's giving you that dry gas, what you get with Range and Antero is you get a mix and also a very advantaged price profile as well.
That was Thomas George, president and portfolio manager at Grizzle Investment Management. Well, aluminum prices rose sharply today after 2 Gulf producers were targeted by an Iranian drone attack over the weekend. We will give you further details on that coming up. Welcome back. 2 of the Gulf's largest aluminum producers were targeted by Iranian drones and missiles on Saturday, sending aluminum prices to a 4-year high today. Our next guest believes the events in the Middle East are likely to lead to a significant 1.9 million ton market deficit. So let's bring in Bart Malik, Managing Director and Global Head of Commodity Strategy at TD Securities. It's great to have you join us. Thanks so much.
Well, thank you very much for having me.
This sounds like this could be pretty big. So can you explain, first of all, to our viewers why this strike over the weekend has impacted the aluminum market so much?
Well, this market was already heading for a deficit with previous force majeures and shutdowns. This just adds to the problem of having not enough aluminum for the year. And the problem is once you shut those facilities down, once the smelter is off, it may take 6 to 9 months to a year to reopen it. So my initial 1.9 million ton deficit could be significantly higher. And we continue to think that prices will reach unprecedented levels with, on average for the next quarter of maybe $3,700 per ton. Even higher. Last time around in 2022, it reached 4,000, and that is a very, very high price.
So what is the trickle-down effect of prices if they reach that level?
Well, sure. The trickle-down effect is that the inputs for everything from automotive to, let's say, air conditioning, manufacturing cost more money because the input for those goods, quite often is aluminum, and its price just has surged. And the problem is even much worse in the United States. They're paying somewhere around a $2,300 a ton premium because of the tariffs. So as the international price moves higher on the LME, U.S. prices will likely skyrocket as well, making it much more expensive over there.
So let's break it down even further. Like, which end products or services do you expect will see a significant price increase? I take your point in terms of what sectors and manufacturing in general, but are there certain end products you can highlight?
Well, sure. You don't have to look beyond, too far. Let's say you have aluminum windows. The frames are made from aluminum. That, a large portion of that cost is the metal itself. So when aluminum surges, that cost of construction surges for those windows. Aluminum wheels for vehicles. Those very nice shiny Meg wheels. A lot of them will have aluminum content. Certain engine blocks. There's been a large incentive recently to lightweight automotive products to increase efficiency and so on. Well, the way you make a vehicle lighter is by giving more aluminum to it. In essence, more aluminum per vehicle. So there's a whole slew of product across many, many, many areas. Automotive is one. Other manufacturing from, the heat shields for the heat shields for air conditioners. We used to use a lot of copper. Now I think a lot of it is increasingly using aluminum. Aluminum for high voltage power transmission. So there are many, many, many uses. And of course, let's not forget beer cans and cans for other beverages.
Of course, so many uses. And when it comes to regions of the world, are there some areas that would be hit harder by this?
Well, anyone who uses it gets hurt. I think United States gets harder because they've imposed a 50% tariff on aluminum. We've already seen, as I said, $2,300 premium called the Midwest premium, the physical premium in the United States. That's going to be likely even higher than it is now, making things more expensive to build there.
If prices rise too high, I wonder, could China take some of the necessary steps to unlock more supply and restart a number of old, idled smelters in that country? Is that an option?
Sure. Over the long run, everything is an option, but we're going to have expansion in other parts of the world, but that takes time. You don't respond very quickly. It could take, many, many years to do that. And I think a lot of the smelters were shut down for, quality of life reasons. There was too much pollution. And for them to be reopened, you're going to have to make some structural changes and big investments. And, if you were to start these projects today, it's not going to happen overnight. It's going to take a while for the supply to adjust because, well, it just takes time to get things moving. Even an existing smelter will now take 6 to 9 to 12 months to reopen if it's been shuttered.
That was going to be my last question, right? Because it's the same kind of conversation we're having around oil. Everyone's looking at how long will this take to resume production and resume what we had before this conflict. So as you say, it will take a while, and the aluminum market was already tight before this.
That's correct. We already had it in a small deficit, and now we're going to have, in a significantly bigger deficit. That means the market clears significantly above the marginal cost of production, which is, tops out about 2,900. So we could easily see, as I said, 3,700 average quarterly price, as I put out in my report.
Wow. Okay, we will leave it there. Bart Malik, Managing Director and Global Head of Commodity Strategy at TD Securities. Really appreciate you joining us. So interesting. Thank you.
Thank you so much for having me. Bye-bye.
Bye. Up next, markets edged higher today, but they still remain volatile amid all the geopolitical uncertainty. We'll get more on that when we come back. Stay with us. The federal NDP have chosen a new leader. Filmmaker and activist Avi Lewis won on the first ballot, beating out 4 other candidates in the race to replace Jagmeet Singh, who swiftly resigned after last year's disastrous election outcome. Lewis comes from a political dynasty with deep ties to the New Democratic movement in Canada. And as CTV's Rachel Aiello reports, his bold but contentious policy ideas have some party members excited and others already apprehensive.
Please welcome the new leader of Canada's NDP, le nouveau chef du NPD, Avi Lewis.
Avi Lewis is the new leader of the federal NDP. A decisive victory. New Democrats elected Lewis on the first ballot with 56% of the vote.
This is about all of us coming together to find our place and our power in the thrilling work of building a shared future.
Lewis comes from a progressive political dynasty. Both his father and grandfather led New Democratic parties in this country. In his campaign platform, Lewis proposed to block any new pipelines, impose a wealth tax on the 1%, and create public options for groceries.
The money is there, my friends. We need a government with the courage to go and get it for all of us.
His clear mandate to take the party further to the left, celebrated by many.
NDP! NDP! Avi Lewis has such a clear vision for the NDP. I think he's going to do amazing as leader, and I'm so excited.
We have hope for our future.
Others express disappointment.
I worry that some of his platforms are unattainable, and people might lose faith in the party.
He's got some good ideas, but he scares me a little bit. The militancy there, for me, it scares me.
And now the real work begins.
I think the rebuild is going to take all of us, and I'm really grateful that Avi sees that.
Thank you, everyone. Thank you. Let's get to work.
But his ability to unify is already being tested. As soon as Lewis won, the Alberta and Saskatchewan NDP came out swinging, saying his views run contrary to the party's working class roots.
I know there's been a lot of talk about division, but I think that what we've seen over the course of this weekend in Winnipeg hopefully shows a brighter future for a party that has been, frankly, irrelevant for the last number of months.
Lewis has inherited a party that has a long way to go to reestablish itself as a viable political option. Those I spoke with today said inviting the 4 other candidates on stage was an important first step. Rachel Aiello, CTV News, Winnipeg.
Markets ended the day lower even after U.S. President Donald Trump said last week that the U.S. is engaging with a more reasonable regime in Iran. At the same time, history shows the second year of a presidential cycle tends to be the weakest for markets. For more, we were joined earlier by Sid Mokhtari, Chief Market Technician at CIBC Capital Markets.
We may be faced with 2 colliding cycles, one being what you suggested, being year 2 of the U.S. presidential cycle, which has very poor hit rates by historical measures. We're looking at about 52% hit rate. Average returns are about 1 to 2%. So it's not the best set of results when we look at it historically. We also looked at year 4 of a bull cycle. In other words, 2022 was the low of the this market from a cycle perspective. In hindsight, 4 years later into it, 26, we put them together and we looked at average returns, price patterns of history. We kind of made the case that, first half historically is the weakest part of the year. Second half is better than first half, and Q4 is historically much better in, year 4 of a bull cycle. So I still think we have some challenges to deal with, albeit market appearing oversold by some measure. But it's best to be, treading carefully out there.
Yeah, it sounds like we could almost see them kind of those concepts butting heads a little bit this year.
I think that's a very reasonable argument. We had 3 successive high double-digit returns for the S&P 500, as well as Canada. We've had a lot of good returns globally speaking. So this market is mean reverting, call it negatively by some measure, given some of the gains back. But we think this is still, by definition, a longer-term secular bull market, and this is a mean reversion or a reset cycle year that should be able to give us buy opportunity. I don't think we're there yet, but by some measure, near term, there are some oversold bounces that may develop. There are pockets in the market that are tied to late cycle narrative or patterns that we have talked in the past together. Energy, obvious, at the risk of stating the obvious, is the right pocket. We're seeing MLPs, renewables, parts of utilities. They're all acting quite well. There is money flow, there is alpha, there's a strong momentum and trends associated with those sectors. So, like I said, there are pockets that investors should tactically be engaged in, and they're tied to, call it, commodity cycles and late cycles, if you will.
And are there sectors that lag or dip more than others?
Yes, we've already seen consumer discretionary as well as financials in the U.S. falling, notably into our weakest, quad ranking. In Canada, we're also seeing financials, slipping in ranking, if you will. And if we think we're correct in our estimation, this is a late cycle playbook. Both discretionary and financials should remain in a, call it, penalty box from a rate of change of alpha or absolute perspective, and other parts of the market should do better that are tied to the late cycle, being commodity areas as well as energy and utilities. I mean, we're seeing telcos coming up very nicely in our matrix processes. Our quant factors are also showing low vols and dividend yield, and parts value quality coming up in our rankings. So I would say we just have to be a lot more systematic and a lot more active this year, to be fair with you.
Okay, and of course, I mean, throwing in all this, we've got the oil shock. How does this compare to past oil shocks?
Well, we looked at all historical oil shocks, and we found that corrections are rather drawn out. They're elongated. So we do think this correction that we're seeing in the market, we started talking about detrending phase of the market. We are still in the progress of that detrending phase. We see more downside for S&P 500. TSX hasn't really resolved its what's called an outside month or a bearish engulfing pattern that it has had in the past month. So backup attempts are likely to have some challenges, and then we'll estimate lower levels to be validated. We think TSX potentially closer to 30,000 and under. We can revalidate some of our views. For the SPX, we're looking at 6,000 potentially on the downside. And like I said, we just think we have to be playing this market, if you will, from a more relative strength or relative gains, if you will, as opposed to wanting to being too aggressive in absolute gains. But taking you back to your question, these oil shocks of the past, if there were a roadmap, they are giving us some indications that this correction does have more time behind it.
And what might change that time? If you think when we could drop down to 30 on the TSX, what might change that?
Well, I mean, if we get a sharp recovery within financials as well as consumer stocks along with industrials that have been somewhat lagging with given parts tied to curve steepening peak that we saw in the U.S. Same with Canada. If we get the flattening and inversion in that pattern, it is not necessarily going to be a boring condition for financials. So if that changes, which we don't think that would be the case, then we should be able to see some recovery. But everything we put together, they're all showing us that we need to be expecting more, call it challenges, or call it, no gain, no pain, no gain narrative. We need to do a little bit more work here before we can reset a lot of indicators, a lot of breadth factors, before we can show recovery. But like I said, anything's possible. We just don't have the data for it right now.
That was Sid Mokhtari, Chief Market Technician at CIBC Capital Markets. Up next, a Canadian tech company's sale south of the border hands huge payouts to its employees. We will speak to Cool IT CEO Jason Waxman after the break. Stay with us. Calgary-based Cool IT, which builds cooling systems for data centers, was acquired by American company Ecolab last week for $4.75 billion US. The deal resulted in its employees getting payouts averaging nearly $250,000. Cool IT will reportedly retain its presence in Calgary. And so for more, let's bring in Jason Waxman, CEO of Cool IT. It's great to have you join us. Thanks so much.
Thanks for having me.
So your company had about 650 workers all set to get these really big cash payouts. How was this deal structured?
The way that the deal was structured is we have a deal with Ecolab to be acquired for $4.75 billion. And, as part of the initial purchase that KKR had of the company, they set aside equity so that everybody in the entire company could participate in the event of an exit.
Will the employees that were part of the Cool IT section of this be able to keep their jobs after, or do you foresee layoffs in the future?
Yes, Ecolab came and met with us and said that everybody's going to be keeping their jobs. Luckily, the company is excited to be continued seeing its growth through Ecolab, and they want to retain all of the talent.
And you say the company's footprint in Calgary unlikely to change. What do you mean by that?
Our headquarters, our manufacturing, all of our engineering, the vast majority of employees are up in Calgary. And we can continue to grow, but the headquarters will still remain in Calgary.
I wonder what this deal means for the broader landscape when it comes to Canadian tech companies. Like, is there a message you think that this could be sending about being bought out by an American firm? Is it difficult for Canadian tech players to find enough investment to kind of scale up and compete?
I think, the Canadian market is rich with talent, and you see it in these pictures of the team. I mean, we've got such a diverse set of folks, a tremendous technical base. Part of what we do in liquid cooling is around pumps and other types of mechanical technology. And there's a very rich oil and gas sector that we've been able to draw talent from to go achieve things. So I think there's a huge talent base. I think there's a tremendous future for tech in Calgary.
So you think this is a positive story for other Canadian tech companies that might be looking at this?
Absolutely.
You have been bought out, or Cool IT have been bought out before by KKR, an Abu Dhabi-based sovereign wealth fund earlier. This is one of the biggest exits in Canada's tech sector. Is this motivation, do you think, for other Canadian tech startups?
Absolutely. I think, again, it's a great story of a talented team that started 25 years ago. It's actually a startup that began in a garage, focusing in on liquid cooling just for desktops, for gaming systems. And we've been in this business for 25 years. And I think it goes to show that if you're persistent, if you want to become an expert in what you do, any company that is motivated, brings in great talent, and executes well has a tremendous potential.
We know Ecolab, based in Minnesota, described as a provider of water, hygiene, and infection prevention products and services. How is this going to work? Like, is it expanding into cooling systems for data centers, or will this mean a change of mandate for Cool IT instead?
No, it's absolutely great synergy. They've been entering data centers, and one of the great transitions that we've seen is that artificial intelligence now requires liquid cooling. The systems in those data centers have become so dense, so hot, that you can only do it through liquid cooling. Well, we have the hardware and the equipment. Obviously, as you highlighted, Ecolab manages the water and the liquid going through those systems. And so there's a great opportunity for synergy.
Is there any kind of headwinds that you see or risks in the future, especially when it comes to cooling systems for data centers? We've been talking a lot about so many materials that are usually used for that. There could be a price increase, especially given what's happening in the Middle East. Do you foresee that being a problem for CoolIT and the merge now that's happening?
I think we always have to look at some of the short-term headwinds, but for the long term, I don't see it as an issue. This is a secular trend that really has just begun, and I think it's going to continue for well over the next decade.
So what's the process now? What's the end date in terms of this buyout, the payouts for employees? Like, when do we expect everything to be said and done and the dust settled?
Yeah, Ecolab has said that the transaction will close in the third quarter of this year.
Okay. Jason Waxman, CEO of CoolIT. Appreciate you joining us. Thanks so much.
Thank you. Take care.
Coming up next is time for Hot Picks. We will zero in on 3 plays in the pharmaceutical sector right after this. Stay with us. Welcome back. It's time now for Hot Picks, and today we are zeroing in on 3 plays in the pharmaceutical sector. We were joined earlier by Evan Siegerman, Managing Director and Head of Healthcare Research at BMO, and kick things off with Merck as his top pick.
Let's talk through why we like this name. First of all, it's not going to be falling off a cliff. It's going to be more of a glide path down. But Merck management has done an excellent job recently of dealing with that. They've done acquisitions. They have had some really interesting data at the ACC, the American College of Cardiology meeting this weekend in New Orleans. And they're basically putting together a constellation of assets to help maybe not necessarily grow rapidly through that LOE, but definitely stabilize their earnings and revenue. We like the recent proposed acquisition of Terns Pharmaceuticals. We think that was a great deal at about $6 billion, could be a multi-billion-dollar asset in the early 2030s. So all in, while pharmaceuticals always have those LOEs, we like what management is doing to solve for the issue that all these companies run into.
And what do they get with that Terns acquisition?
They get a drug for a rare type of leukemia. We saw some really good data at the hematology meeting back in December. And with that, it could potentially move into earlier lines of treatment, very competitive in the space. It's a small molecule, very easy to give, has had some fantastic efficacy.
Can you remind us, has Merck made progress in the area of obesity/diet drugs?
So they're actually not indexing to obesity and diet drugs. And I think that's why some investors actually prefer the name and why we actually prefer. While we do like Lilly, we've talked a lot about her on this program. I think it's important to have investments in the pharmaceutical space that aren't so tied to obesity. I think Lilly and Novo will be the winners there, and it's really hard for an entrant to really make progress. They have some assets in the cardiovascular space, but not indexed specifically to obesity.
Right. Your next idea is Disc Medicine. Yes. The symbol is IRON, I-R-O-N. Remind us what they do.
For sure. So they are a smaller biotech name. They were actually kind of at the, not really involved in controversy, but they were awarded the commissioner's priority review voucher for the review of their lead drug, bitopertin. Unfortunately, it was surprisingly rejected, but do not fear. They have the requisite phase 3 data coming later this year. They just announced over-enrollment of the trial, which is a good sign in our view. We think that they could have this drug on the market by next year. And beyond that, they have drugs also for other rare types of blood conditions called PV and MF. All in, in the small biotech space, kind of along the lines of Terns, but not in cancer per se. They're niche, but really could add multi-billion dollars to a big pharma portfolio. So we think that at some point they could be taken out.
And people are keen to enroll in the latest trial?
Well, actually, the trial is enrolled completely for their phase 3 trial for bitopertin. It's a rare disease called EPP. Essentially, it's this vampire condition where because of a toxic metabolite in your blood, you have very bad kind of reaction to sunlight. And this drug really helps these patients. It's an easy take pill and could be, it's a rare disease, so there are thousands of patients, so there's a high potential price tag, so it's an easy drug to market, but the drug works very well and is very safe.
And Regeneron, and they are active in this GLP-1 area as well. But remind us what their drug is doing, though, please.
Yes, but that's not the reason why we like the name. So I'll touch on GLP-1s in a second.
Sure.
But we like the name because they have a growing oncology business with a key catalyst coming in the first half of this year, and we're positive on it. It's a drug for metastatic melanoma. We think that it's going to be successful versus kind of the standard of care out there. They do have some efforts in obesity. They have a GLP-1 GIP that they licensed from China, but they're also looking at the muscle preservation component of weight loss. But beyond that, they have assets in immunology and, of course, ophthalmology. And that's why we really like the name. And, of course, we would be reticent to, ignore Dupixent and what comes beyond that. That's their blockbuster partner with Sanofi.
Sorry, what was that last product that you mentioned, Evan?
It's Dupixent. It's their blockbuster product partnered with Sanofi for atopic dermatitis and asthma.
That was Evan Seigerman, Managing Director and Head of Healthcare Research at BMO. Well, the City of Toronto has voted to move forward with a controversial new idea to try and cut the costs of groceries. Not-for-profit, city-run grocery stores have gained momentum since New York's newly elected mayor brought it forward. But as Kamal Karamali tells us, there are those who believe the pilot project is destined to fail.
I'll put that right there. It was an idea served up by New York Mayor Zoran Mamdani that's been gaining momentum. Not-for-profit, city-run grocery stores.
Motion 4A carries the...
Now, the City of Toronto voted Thursday to become one of the first in North America to test out municipally operated grocery stores, 4 locations, meant to create more competition against the privately owned grocery giants by offering food items at a subsidized price.
To ensure that the lowest possible food prices are attained.
Grocery shoppers with an appetite to try anything to cut food costs.
I think anything that we try that's innovative, and if it works, why not?
Just ask Maria Sanchez, who struggles every week to afford quality foods.
I'm a single mother, and it's just hard to find good, especially products.
But there's a belief the city is biting off more than it can chew, with profit margins for food already razor thin.
Every dollar that you put through at the till, there's about 4 cents that is coming back as profit. Can they match the purchasing power and the efficiency of the for-profit sector and then deliver it without that profit motive?
Other Canadian cities watching closely, Ottawa has its staff exploring the idea.
There are people that are very positive towards it, and there are people that are very much against it.
While Vancouver councillors instead wanting to put more money into already existing independent grocers and co-ops.
And allow them to do what they already know how to do rather than us step in and try and take over in something that we have absolutely no expertise in.
Toronto City staff are expected to report back to council with a plan a year from now in spring of 2027. So it'll still be some time until we see these city-run grocery stores turn into a reality.
That was CTV's Kamal Karamali. Ottawa and Ontario have come up with ways to cut the cost of buying a home. A major agreement on housing today, which Premier Doug Ford calls historic. CTV's Annie Bergeron-Oliver has more on what it means to you if you're in the market for a home.
Ready? After 6 years living in a suburban townhouse, Brittany Roddick is ready to upgrade to a bigger home with more space to play catch.
We wanted something with a bit of a bigger backyard and just room to grow.
Roddick has a new build and a lot all picked out. The only thing she's waiting for is the government's promised tax relief measures to officially take effect.
It really just made everything more attainable for us. It was so exciting.
Starting April 1st, the Ontario and federal government are removing the GST, HST on the purchase of new build homes. For properties valued up to $1 million, that's a 13% savings, or up to $130,000. On homes between $1 million and $1.5 million, the savings max out at $130,000. For properties $1.85 million and over, the max $24,000.
This partnership will provide almost $2.2 billion in total tax savings for Ontarians, and it will catalyze housing starts in Ontario.
Ontario and the federal government are also committing $8.8 billion to help pay for infrastructure projects, so municipalities can reduce development charges by half for 3 years.
They've increased a massive amount over the last 25 years. So the City of Toronto, they've increased by over 5,000%.
The Conservatives doubt the changes will lead to any results.
I worry that 1 year reprieve on the HST and only 3 years of getting development charges down. But that's not a long enough window for really getting the housing construction business moving again.
The government says municipalities will be expected to reduce development charges, but so far many have been hesitant to do so, saying those fees are necessary to get sewage, water, and other infrastructure projects built without transferring the costs to taxpayers. Annie Bergeron-Oliver, CTV News, Ottawa.
And that does it for today's program. Thanks so much for joining us.